I am very much looking forward to our conversation. This will not just be a conversation among the five of us. This is an opportunity for you to participate as well. We have a sheet that we have created where you can enter in your questions. Hira is going to help us manage that. In the chat, you see a link to a Google Doc where you can go and type in your questions as we go. As we get to the end of our session today, about the last 10, 15 minutes, we'll go to that. So we would love to hear from you. As a question comes up, just type it into that sheet and we'll proceed from there. I intend to ask our panelists some questions that I'll give them an opportunity to share their experience, their thoughts on early stage startups and MVP offerings. I'll also have a few quick round rapid fire questions just to see their thoughts on things in general. So enough about that. Excited to be here with all of you. Dan, Amy, Vic, and Lior, thank you so much for joining us. I'd like to ask each of you in turn. We'll start with you, Dan. We'll go to Amy, Vic, and then Lior, just to do a quick introduction of yourself, your firm. And I'd love for you to share what is something you've learned early in your career that you're using today that helped you. I know several of you have an affiliation with Stanford and the business school where I teach. And I'd love to hear if there's something related to that or just something otherwise that's been helpful to you that maybe others listening in can share with us. So let's go ahead. Dan, why don't you introduce yourself? Tell us a little bit about what you've got going on and something you learned early in your career.
Sure. I'm Dan Matthews. I'm the founding general partner of Reaction, which has about 200 all Stanford LPs, around 50 countries in the world. Prior to Reaction, I was a corporate entrepreneur, basically a business builder. I know someone shared with me early on that the first third of your career is learning, and the second third is leading, and then the last third is giving back, sort of lending what you've accumulated through that journey to others to help enable others. And so I transitioned from building several businesses, global businesses within Bloomberg, through Stanford's executive program 2 summers ago, and then building Reaction as a way to enable many of the founders in our ecosystem to take what they've built and to bring it global. And thinking to Matt's question about early on, I actually started my career in the very early days as a rock drummer in the 90s. And so if you can remember, for those who weren't there, it was a fun time. You had long hair, ripped jeans, rebel bands. And what I learned from that playing in the band was the importance to really listening to and elevating the other members. And the downfall, I think, of most musicians and professionals, they focus on themselves. So you're eager to play, you're eager to perform. But the problem is when you're in that state, you fail to listen to the others. And you think that you're going to take the stage, the audience is mistakenly going to believe that they'll be impressed by a great drummer or a funky bassist or a killer guitarist. And that's not what gets them to dance, right? It's how you rock out as a band. It's a different skill. It's playing music together. I mean, I don't think anyone would go to see a band with 4 drummers or 4 bassists. And so, what you're trying to do is really listen. If the guitarist is playing a solo, how do you help her to shine? If the bassist is trying to add some funk, how do you complement that? How do you start to get a few more people to dance? If the lead singer is out there and she's got great energy, how do you add to it? How do you elevate it? How do you bring it to bring people to their feet and really get them to dance? And so I think the expression that there's only one rule for being a good talker or player is to learn to listen. It's that cohesion as a team, or listening to each other, or combining talents in a way that the sum is greater than the parts. And the way that elevates each other is also what makes great ventures work. And as we're listening to great ventures speak, it's noticing the cohesion and the ability to really rock out together.
Wow. So I don't have the ability to multitask well enough to Google to see if I can see pictures of you from the 90s with your long hair, but I know that I'm going to do that at some point just to check in. But no, excellent advice and great history there. And I'm a big supporter of that idea of how one looks at their lives in terms of doing, leading, and then giving back. So thank you, Dan. Amy, we'd love to hear from you, hear a bit about the business you represent, and then any advice that you learned that's helpful.
Yeah, thanks, Matt. Thanks, Matt and Hira, for having us. And Dan, I'm not sure I'm going to be able to top that, but I'll do my best. Nice to meet you, everyone. I'm Amy Cheatham. I'm a principal at Coast to Noah Ventures. We're an early stage B2B software fund focused primarily in the US. And I think the best learning or piece of advice that I've had is Early in my career, I had an experience of working at Summit Partners, which for those of you that have heard of Smile and Dial Venture Capital will understand that it's a very outbound game. And I think the best thing I learned there is that everything is sales. And like, no matter what industry you work in, no matter what your job is, you have to sell something. It might be yourself, it might be money. In my case, it might be a product. And learning that skill early on is so important. And I think just being confident in asking for what you want as a part of that sales process is something that at the time felt painful to learn, but I think has been incredibly important as I've grown in my career.
Excellent, thank you. And I think everybody on this call can benefit from learning how to be better at selling themselves, their businesses, their ideas, et cetera. Thank you, Amy. Vic, let's move on to you. Share with us a little bit about yourself, your company, and something you've learned.
Yeah. Hey, everyone. Great to be here, and thanks for having me. I'm Vic. I'm an investor at First Round Capital. We're a seed stage sector agnostic fund, so we invest across everything from consumer to deep enterprise, primarily in the US. Throughout my career, I've worked at early stage startups, large companies in tech, went to business school at Stanford, and now work in venture capital. And I think the one lesson I've consistently pulled across all of those, whether it's from a scaling startup or investing in them, is how everything is people driven. Understanding people's incentives, what they care about, building relationships, it all helps get things over the finish line that people may not have wanted or expected. And I think it's something that I try to remind myself and focus on, especially given the nature of the jobs that we're all in.
Excellent, thank you. Good lesson for all of us. Excellent. Lior, can you do the same? Names, company, lesson learned.
Yeah, absolutely. Hi, everyone. I'm Lior Mushin. I'm an investor at Floodgate. We're also a sector agnostic firm focusing on 0 to 1 only kind of pre-product market fit in the United States. And I'd say that one lesson that I learned in high school, I was a crisis hotline counselor. And one of the things that I remember trying to do initially when I was on the phone talking to people when they had something going on in their lives, is I was trying to give them advice. And one of the best pieces of advice is that I got from a mentor there, that sometimes the best thing you can do is just to help people help themselves. So that involves active listening and not necessarily telling them you should do X, Y, or Z, but I found that many times people have the answer within them. And so your job is potentially as an investor when they have certain types of questions, and also just as a friend, is to kind of be that sounding board and to be that mirror.
Excellent, thank you. Again, useful advice. Sometimes I heard the idea of listening come up in both Dan and Lior's comments. So thank you. Those are your panelists. Before we get started with the questions, I am looking at lots of pretty faces and pictures and sometimes just names. If you all have cameras on your system, we would love to see you. If you're in a place where you're comfortable, show your image. As somebody who teaches at the business school, I love to see my students' faces, not just their pictures of their faces. Great, thank you for those of you coming off of the muted picture. I'd love to see you there. Go do me a favor and go to the reactions button now and just give me a thumbs up if you happen to be currently a founder of a startup, a co-founder, or somebody involved in an initial small team. Just curious to know how many of you actually are founders who might be seeking funding to know. So I'll go to the reactions button, just do a thumbs up. Let's see if anybody falls into that category. All right, I'm seeing some thumbs up. Andrea, Anna, thank you. Also see Karen, Paolo, very good. Philip, all right, Richard, great, thank you. So the rest of you are here potentially with ideas in mind or thinking about what it could be like for you. So thank you for joining us as well. So let's go ahead and get started. Great to see all of you now on camera. My first question, let's have this question. We're gonna ask Vic first. MVPs mean different things to different people. How do you view what an MVP is, a minimally viable product? What does that look like from your perspective?
Yeah, that's a great question. An MVP it's typically a product that you can give to a user, and they can go use it to perform a task. And it's kind of like, I think of it as the output of the customer discovery you've done, the insights you've gathered from it and some of the product development, like very basic product development work that you've done in order to go test with users whether your hypothesis is true. Depending on the industry, I could consider anything from like high fidelity Figma mockups if it's something in application software. If it's something that's a little more technically heavy, I'd consider it like an actual product that someone can use and test to understand if it fits their needs.
Excellent. Thank you for that. Amy, I'm wondering if you have a similar view or maybe a different view of what MVP means?
No, I think Vic said it really well. I mean, I think of it as it has just enough features to attract early adopters, but not enough stuff set in stone to not allow you to take customer feedback and put that into the product. So just enough that people can use it, I think, is sort of the way I think about it.
Excellent. And let me stick with you for a second longer, Amy. What is your investment thesis around MVPs and pre-revenue products? And then I'm going to jump over to Lior and hear yours as well.
Yeah, well, I have a sneaky suspicion that the three of us and probably Dan as well have similar answers here. I think in today's climate where there's so much money floating around, it's really hard to have super set in stone, we don't invest pre-product type hard lines. And so right now, I think we're probably a little more flexible than we were previously, where we're investing in things before there might be a product in certain situations. I think for us, that's usually only in markets that we know really well. Fintech, as an example of one that I feel comfortable doing that in. But in others where we're maybe not as comfortable, we would certainly want to see an MVP. So that's a really annoying "it depends" answer, but that is the honest answer at the moment.
Well, and that's what we're looking for. A lot of people in the boat as first-time founders or folks with just rudimentary ideas, they want to know what it is. They want to know the truth and what's really going on out there. So thank you, Amy. Lior, would you add anything to what Amy said about your investment thesis around MVPs?
Yeah, absolutely. I think the core of what I would say is similar to what Amy had just mentioned. But I'd say to add to what she had mentioned is to say that I think a lot of times we're looking for potential energy. And so that potential energy can come from a variety of places. That can come from the background of the founders and how authentic this problem was to them. This potential energy can come from wait lists that they've created or advisors that they've assembled. And so from something that's pre-product, you can have like a landing page and kind of gather users as a means of kind of testing the insight. And tools like that, or potentially getting an advisor to believe in you that has the ability to kind of speak on your behalf and your ability to get the job done, so to speak, I think is just another important component as we think through anything that's kind of pre-product and pre-revenue.
Okay, so it's much more to you than just the product. It's also the team and their energy behind it. Thank you. Dan, let me ask you this. How do you validate demand before the product fully exists? What are some of your thoughts on how you look at demand?
Sure, and for context for everyone, we're an emerging growth stage, which means that typically Series A, Series B, and we're validating demand, quite honestly, Matt, through a paying customer that's a referenceable customer. And so we talk about MVP, we're really looking for an MV, product market fit, and that the team, the model, the product have been embraced at least at an early growth stage. And per the name early growth, you've come from a lot of things that have been tried and failed. You found the one that works, and now you're ready to start having doors opened up so that you can scale that growth, and that's where we can help.
Excellent. Lior, do you have any thoughts on the validating demand?
I think many times, I think what's interesting is seeing if there's examples of latent demand. And so in the case of Airbnb, there were folks, renting out apartments on Craigslist, for example. In the world of streaming services, for example, that you could kind of test out that there were instances in which people were watching other folks, like for example, the example of Twitch. I think they were basically the way that Justin TV got started was showing Justin Khan's life as he was walking around. And while it doesn't necessarily show that you're going to be able to have a streaming service or a way for people to kind of watch someone else like play a video game, for example, I think it kind of just was showing that people were willing to watch alternative content. And then, in Justin.tv's case, which did eventually later become Twitch, they eventually kind of honed in on what was the most popular service on Justin TV at the time, and then they were kind of able to build a product around that.
Okay. So thank you for adding a little detail to what Dan said from at an even earlier stage than Dan's firm tends to look at. Vic, I want to come back to something that Amy alluded to, that in different industries you have to think about MVPs differently. Are there industry specific expectations for MVPs that you have, for example, fintech, healthcare, et cetera?
Not particularly. I think
okay.
Amy summed it up well, which is in industries and markets where I have more expertise and I've seen more companies, I have a better sense of what could be built and what could happen and what may have demand. So I'm willing to dive earlier than a product or actual customers using it. Whereas in a market that I don't have a lot of clarity on, I kind of would like to see a few more data points.
Okay. All right. So it really depends on you as a VC investor, potential investor, your background. It helps you decide how far to look. Thank you. Amy, I'm wondering what guidance do you provide or can you provide to help a company figure out how much money to actually seek or raise?
Yeah, it's a great question, and I think one that's top of mind for a lot of folks right now with so much capital in the ecosystem. There are a few different ways to think about it. I think there's a lot of good advice around trying to raise as little as possible early on before you get product in market and before you start to get early signals of product market fit, because I think overcapitalizing too early can end up being detrimental, because that usually means higher valuations and therefore higher expectations for the next round that you're raising. So you're sort of trying to thread the needle between keeping expectations reasonable, but raising enough capital to do the amount of diligence and customer discovery that you need to go to get to the next step. And I think a lot of that comes down to how capital intensive the product that you're building is, right? So if it's infrastructure software, something that's going to take a lot of development, probably take longer to get off the ground. Same thing with if it's a consumer product or something that just takes more capital in general. I think the answer to that question will differ, but for a middle of the road, like B2B software company, I think you can give reasonable guidance around what a reasonable pre-seed, seed, and Series A round might look like, based on thinking about those as timelines for the business to get to product market fit.
Excellent. Okay. Dan, Vic, or Lior, would you add anything else to help us better understand how to provide guidance on how much money to raise? Anything you'd like to share there?
Sure. I like to see companies at the later stage raise a lot of capital for a few reasons. The first is it takes a lot of time to raise capital. And you'll find that maybe they're giving 50-80% of their time and focus to that raise, and if they keep on doing that every year, and each round is taking 4 to 6 months to really close down, it's a huge distraction. The second is opportunities. For example, we just invested in a Series B, where the company raised 50 million and they only needed 10, but they had some acquisitions that they could roll into it to accelerate growth. And they didn't want to sit there and say, when that comes about, we'll start over again. They said, look, we want to be ready. We want to move. We want to scale. And then the third reason is you want to see a vote of confidence. You want to see that they might need 10, but there's 80 million that's available to them. They're going to pick and choose the 50 that they decide on, but it's not that they're asking for money. They're looking for partners. And there's plenty of partners that really believe with their wallets and their minds and their hearts and their souls that this is going to be a success.
Yeah, I think just to piggyback off of that, to connect the dots from Amy to Dan's world, and also Amy's world being a little bit more closer to mine, is that at the end of the day, if you don't necessarily have product market fit and you raise too much capital, a danger you might have is pollution. And so by the time that you are going into the world of raising your Series B and raising that $50 million, and many times you're making that trade-off at the early stage, as to potentially raise less capital for less dilution. And the idea being that you're able to kind of navigate and find product market fit. The worry is that, let's say, you have the opportunity to raise 2 versus 6, which, is an example that I went through recently. That, raising 6 is nice, but 1, it's more dilution, and 2, in the instance that I'm talking about, the founder doesn't necessarily have product market fit. And if you're raising 6, you're kind of off to the races doing that specific idea. What I think we would rather see is you raise a little bit less, and by the time you get to Dan's stage, you're dumping in the capital and putting your foot on the gas.
Excellent. Thank you. Vic, let me ask you this, and then I want to hear from some others as well. How much of a team do you expect to see at this early stage?
Ideally, the full founding team.
Right.
That includes, we invest when there has to be the team, because at the early stage, especially like the seed, the pre-seed, like that's basically all there is. And you're betting that they can overcome market challenges, product challenges to really build the business. So we want to see if it's a really technical product, a highly technical team. If it's a product focused on healthcare, we want to see 2 people that have spent time, whether it's working in healthcare or diving into the specific problem for months. We want to see people with expertise in the problem that they're solving and background to go solve it. That's a must at the stage we invest in.
Okay. I know many of the people listening in are in the midst of forming teams and looking at building out teams. I'm wondering if Amy or Lior or Dan, you have thoughts about what a team should look like at this stage and what you look for in a team at this stage.
Yeah, I can jump in on that, and I agree with everything that Vic said, and I think particularly to his point around technical expertise, if it's a technical product, and I think, look, an ideal founding team to me has, assuming this is a technical product, has a technical leader in place and then someone that can hopefully bring the go-to-market and business mind, assuming that perhaps the technical person doesn't have that. And look, I think it's rare to actually find that, right? It's pretty frequent that we find teams where there's 2 business-minded people or 2 technical-minded people. And so the more cognizant you can be of having a diversity of experience and diversity of background when you're building that team, I think the better it's going to be for the business in the long term. And maybe it's not 2 people, right? Maybe it's 3 or 4. I don't think there's a right number necessarily, but I think having those dynamics in place, and to Vic's point, having a fully formed team when you invest is so important, because half of what we're investing in is the team dynamics and whether or not that team can stay in place. And I think co-founding with someone is kind of like getting married to some extent, right? And making sure that we feel like that team's going to stay together is such a core part of that thesis. And so if it's not fully formed, it makes it really hard to invest in the team dynamics.
I think, back to the music analogy, one of my favorite bands is Foo Fighters, right? And Dave Grohl was previously Nirvana, and we're going way back for many of us. But you had a successful guy the first time around, and the second time he's able to build a great band and have repeat success. And you're really looking for the same thing, both in terms of cohesion across the group, that they can play together, they can really complement each other, they can in many ways elevate the product of the group, and second, that they're able to repeat that over time, and you see that they're not a bunch of drama queens that are breaking up and getting together, and all the things that you see in both the work stage and the the music stage. That's the type of thing that you want to avoid.
Yeah, I think the interesting thing about it all is that, for us, I would even say the percentage is 70-30 founder insight. And, if the team is not necessarily formed, that means that things have had to be de-risked otherwise. So if you're in the mode of building out, an MVP and, potentially in a more complicated, technical arena or not, if that team is not fully formed, then, you're having to kind of try to de-risk it for the investor in other ways. And so it just becomes tougher let's say you do have domain expertise, but you're missing an element of the team that you might find to be key in that particular vertical. That it just becomes a tougher proposition for the investor to kind of dig in a little bit further on that specific opportunity.
So lots of good advice there, thinking about the teams, what they need to look like and how to build them. In a moment, I want to ask each of you to share an epic MVP success or epic fail that you were part of or know of. But before we do that, I'll give you a chance to think about that. In our preparation call that we did for today's event, Lior and Dan, you spent a little bit of time talking with me, but also with each other about this notion of founder market fit. And I know we've touched on it a little bit, but I wanted to give you an opportunity now, both of you, if you wanted to share a little bit of those thoughts that you discussed, if you think there's something more to add to that discussion, to what we've already said. So I don't know if either of you want to add something more to the notion of the founder market fit that we talked about a week or so ago.
You know, the idea of mentoring comes up a lot, and companies needing mentoring. And I think you almost want an example of a company that is the best in the world at what they do. Doesn't matter what it is, that they're the best in the world. As an example, we invested in a company that does autonomous retail stores using computer vision. And you know, they've got a dozen PhDs on staff. They've won the gold medal in all these engineering competitions for accuracy of products and speed and processing and so forth. So the idea of us coming in and saying, hey, we've got a bunch of people that know about artificial intelligence or computer processing is kind of irrelevant. They have taken the skills and the knowledge and the dreams that they have, and they've put themselves in the right position to succeed. And what they need is not mentoring, but enablement, to be able to take their product, their dream, and expose it to the world in a way that makes them successful.
Mentoring
I think just,
go ahead, please.
Sorry, go ahead, Matt.
No, I was
no,
just going to say
gonna
mentoring is critical.
Yeah.
Go ahead, Lior.
Yeah, absolutely. I mean, I think that, you know, there's a couple of examples that do come to mind, but the question that comes up to me often is, why is this your life's work? That's something that we do, think through, and you worked on it your entire life in some form or fashion, or maybe you have, potentially been working on this for a while. But in an example recently, we had a couple of technical founders working on a consumer product, and you can tell it was just an idea they thought was interesting, as opposed to being their life's work. They have been, and perhaps the people in this panel know what I'm talking about, but they eventually pivoted to something a little bit more fitting of their, technical expertise. And they were having a hard time raising on the consumer product, and eventually an enterprise product, which was a more native and more authentic product to their skill set. They were able to raise quite a good round. And I guess the trouble they were having, which I think is real, is that, again, they didn't have much traction. It was pre-product, and making the argument that they were the best people in the world to work on their first product was just a tough proposition. Whereas by the time they raised for their second product, after spending a year trying to fundraise for the product that did not work, they were able to raise for the more technical product in, I think, 3 or 4 weeks. And so again, you just have to ask yourself, like, why am I one of the best people in the world to work on this problem, and why am I going to want to spend 10 years potentially working on this specific idea?
Excellent. Both really insightful ideas there around mentoring and finding the right fit and the passion behind it. All right, I would love to hear some successes and some failures. And Vic, I'm wondering if you have an example of an epic success or an epic fail, and maybe a lesson learned from whichever you choose to share.
Of an MVP, right?
Yes.
Yeah, we were recently looking at and invested in a founder who seemingly actually didn't have the best founder market fit. And we look at that like very, very closely, which is like, is this going to be your life's work? Have you done the work to understand the problem? And from his background, it didn't seem like it. And I took the meeting, and he was building like a visual workflow editor for financial professionals, like people who want to trade. And when he pulled up the demo and walked me through how powerful the product was and the types of trading strategies you could build on it, I think I realized that he had actually been spending his nights and weekends, without saying it, for the past years thinking about and building this product. And I think that was like the culmination of me realizing, oh, wow, this really could be this guy's life work and what he cares about. And I think everything kind of clicked at that moment by seeing just like his level of attention to detail, to what his customers care about, to attention to level of detail of what the product looks like and why. I feel like when people go 3 or 4 levels deep on those product details, it can really be a tell for how much they care about what they're building. And I know we talked a lot in this session, or for the past 30 or so minutes, about investing pre-product. But I guess some of the benefits of, and we do that as well, but like some of the benefits of seeing the product is you can actually see the craftsmanship that went into something, and building a product and building a company is all a craft. And the first iteration or the MVP of the product is kind of like the first time the founder gets to like show that to the world. And that was like a big win for the founder, which got us and me and subsequently the rest of the firm excited about what he was building.
Wow. So the passion and the detailed time spent on, in that case, the product that was able to demo. Thank you. Amy, do you have either a success or a fail that you can share, and some lesson that we can learn from it?
Yeah, I'm trying to think of good ones. On the success side,
sometimes we learn more from fails.
No, that's totally true. Thankfully, I haven't had too many of those yet, though I'm sure that will happen. The one that comes to mind is a company I invested in quite a few years ago now, back in 2017. It's a company called Podium that's in Salt Lake City, and sells, it kind of connects to Vic's story of very seemingly lightweight product when we first looked at it. And the initial product was essentially to help car dealerships and other auto dealers collect and solicit reviews. Very simple application. I remember seeing the first demo, and we had scheduled an hour slot, and we were 5 minutes in, and the CTO was like, and that's it. And all of us were kind of like, okay, where's the rest of the product? Like, we thought this was going to be, very in depth. And the basic product was really just a text message that these dealerships could send on their own from, a web interface directly to the phones of their customers. And I remember walking away feeling so disappointed, because this company had scaled so quickly to such impressive revenue. And we just felt there's no way you can build a big business when that's the first product that you see. And we kept doing our diligence, kept talking to customers, ended up investing anyways. And as anyone that has followed the company will know, like, it's been really successful, but it was such a lesson in listen to customers and pay attention. Like, where there's smoke, there's fire, meaning in a good way, right? Where people were buying this, they were paying money for it, and it seemed so lightweight, and so, like, if you had looked at that in a vacuum, you would have ignored the rest of the company, because it's probably one of the worst demos I've seen in my life. And the company has ended up being incredibly successful. And there was this clear need for a really simple product, and they've been able to build so much around it. But I think the lesson to me was, listen to your customers, and 2, even if the product is really simple, if people are using it, pay attention to that, and you can build more products around it. So, sort of a disastrous demo that turned into a wonderful company, I guess, is the moral of the story.
I love the way you distilled the lesson. I'm just going to put an exclamation point at the end of that. Let's hear from Dan, and then Lior, and then I've got some rapid round questions. And I know Hira is asking for all of you to put your questions starting now into the document, so our panelists can get to those questions. Dan, an example of a epic success or failure you can think of?
Yeah, sure. I can tell you a story of epic failure that I was the business leader on, actually. And in a classic venture, you would start with the MVP we've been talking about and get some initial traction. Take, like Amy said, some feedback from customers, continue to refine that. And then when you're confident, you see how fast you can go. And that question about how fast can you go was there at the outset. And what we did, the wrong thing, was to build a huge sales force. We had close to 100 people that were in a sales force, knocking on doors, pushing a product that wasn't ready for market. And ultimately, it became such an expensive business, it couldn't get to a profitable state fast enough, and was shut down.
So be very mindful of how hard you put your foot on the accelerator before you've got that product that can really get you some traction.
You're going to be pushed. Whether you're at a corporation or you're at a venture, you're going to be pushed for how fast can you sell it? Can we show bigger numbers faster? And the tendency is to say, yes, we can. Yes, we're going to do it. We just need to hire the right sales force and knock on more doors, more shots on goal, and that's going to turn out great. Only if the product works. And if the product's not there, it's going to turn into a very expensive mistake.
Excellent. Thank you for distilling that advice. All right, Lior, let's hear it from you. Success or failure?
Yeah, absolutely. So earlier on in my career, so far, no failures. Although I know they're probably coming from a humbling piece of this whole job. But I'd say that one person that I really admired. So I ended up investing through an angel fund that Vic and I actually ended up starting. But it's a friend of ours that he started off creating a curation platform for sports news. And he had this thesis around curation, and that was kind of the core piece of the business the whole time. But at first it was kind of just sports only. And I think the thing I've loved about what he's done so far, and he's just raised a little bit of money from a great venture firm, is that he never stopped listening to his customers. Somewhat similar to the lessons that other folks have had. I wouldn't necessarily say that you would have necessarily known going into it that his life work would have been curation, kind of to Vic's example. But he really believed in it and did all of his research, and you can tell that he had navigated the idea maze and found, early product market fit. It's still a little TBD, but that's a really good case of someone who, had, strong beliefs loosely held and continued to iterate based on the feedback that he got from the folks who were using the product that he was building.
Mm-hmm. I like that. Strong beliefs loosely held. That's something we definitely echoes throughout the halls at the GSB. As advice. Thank you. I'd like now to do some rapid fire questions. This will give where you just have real short answers. And then I'd love to, again, invite people to put stuff into that Google Doc. I see about 4 or 5 questions in there, and we'll get to those questions very quickly. So let me ask Amy very quickly, what's your biggest pet peeve when it comes to pitches that you've seen? What's the biggest pet peeve that really can turn you off?
Name dropping.
Ah, excellent. Thank you. Good answer there. Dan, let's have you follow the same question. What's your biggest pet peeve?
Low energy.
Low energy. Aha, excellent. Anybody who sat in one of my classrooms know that we talk a lot about energy. I'd love to hear, Lior, from you. What are some code phrases you use to share to say that you're not interested without really being too direct about it? So for example, come back when you have a lead might be a phrase that someone would use. What's your code word for thank you, but no thank you, or at least at the moment, no thank you?
Yeah, totally. Not in thesis.
Aha, not in thesis. Vic, you're laughing. What's yours?
The two that I go with are typically a hair too early, come back when you have something, come back when you have a product or more customers, or not an area we typically focus on.
Okay, excellent. So somebody like me who teaches strategic communication, persuasion, pitching, etc., I'd like to hear from each of you. What is the biggest mistake you see founders make in their pitching or pitch decks? Just rapid fire. Let's start with Vic, since you just went, let's have you go again. You'll start us off. What's one of the biggest biggest mistakes you see founders make in their pitch or pitch decks?
I think at a high level, it's not actually crafting the story around why this matters and what this will become.
Okay, so 2 parts there. What's the problem and what's the potential? Very good, thank you. Dan, how about you? What's a big mistake founders make in their pitching or pitch deck?
I'd agree with Vic. It's a lack of simple and clear thinking and being able to explain the problem and really make the problem real and make sure that the person understands the problem and is connected to the problem before you go into, the solution, which can't be about, as Steve Jobs would say, bits and bytes and ones and zeros. It's got to be about a solution that improves lives, improves, the planet, does something that's meaningful.
Excellent, thank you. So really all about relevance, making it relevant to the folks you're pitching to. Lior, how about you? Big mistake made in pitches or pitch decks?
This may be a less obvious one, but putting exits that wouldn't resonate with the venture investors. So for example, like, to make our fund economics work, generally speaking, we need kind of $1 billion plus exits. And so if you put, $200 million exit as a corollary for, where you think this company can go, like that's a great, opportunity for the founder and exit. For our fund and the way that it works, it just becomes tough to, return the fund on that type of, exit in that specific situation.
All right, so good. So not having thought that through. Amy, how about you? Have the final word on the biggest mistake in pitches or pitch decks?
Yeah, I agree with everything that's been said. And the one thing I'd add on the pitching side during the actual pitch is not stopping for questions and not making it a conversation. I really struggle in a 30-minute pitch when it's 2:29 and I haven't had the opportunity to ask a question. So I think just managing the clock and engaging the other person as much as possible.
Excellent. Thank you very much. So I hope people were taking notes on that. I know many of you are considering pitches and pitching or in the midst of it. I certainly took some notes and will be passing on some of that advice to the students I teach and the folks I coach. So I'm very delighted now to switch to the questions that all of you had a chance to enter. And please feel free to ask more. We've got about 7 questions here. Not sure we can get to all 7, but I'm going to try to do my best and combine things together. So a couple questions here are about co-founders or multiple people. So one question is, what about solo entrepreneurs? What are your thoughts on a solo entrepreneur instead of just a team? And then if depending on what you say, the next question is, what are your thoughts about platforms to find co-founders? Any experience with those, and are they any good? I open that up to any of you if you have any thoughts or ideas about solo entrepreneurs, and then ideas about helping a solo entrepreneur find co-founders. Anybody want to take a stab at that?
Sure. I'm happy to just take an initial stab.
Silence.
I think me? Can you not hear me?
I can hear you. I think you're good.
Okay, great.
Okay.
I'm back. Did I freeze? I'm sorry. Who's going to take a stab?
Okay, me, Vic.
Great, thank you, Vic.
So I am, yeah, I think like we typically like to see co-founders. I think we've made a couple of investments where there's one founder, but I think everyone has strengths and weaknesses and self-awareness around weaknesses and kind of shoring up those weaknesses with a second co-founder, whether that's business, technical, go to market, I think is like key to success and having that DNA on your founding team. There are some people obviously that can go do it themselves. I think they're just far and few in between and often tend to be like second, third, and fourth time founders that have like made all the mistakes and have the scars themselves. Platforms to find co-founders, yeah. Co-founder dating, I think is like a very real and great way to find co-founders. There's plenty of platforms to do it. You can also, just like traditional dating before Bumble and Hinge, you could go ask your friends what smart coworkers they know that are interested in exploring starting companies. And I think that's also a great way to kind of like have a warm connection to somebody that might be a great fit personality wise, culture wise, and skill set wise, because you kind of have someone in the middle who might be able to broker an introduction. So yeah, I would say co-founder dating is definitely an increasing way, a way I increasingly see founders meeting their business partner.
Great. Anybody else have thoughts on solo entrepreneurs or finding partners?
Yeah, I agree with everything Vic just said. And I would just add, I think I can think of 1 or 2 cases where we've funded a solo founder. And interestingly, thinking about the 2 cases, it's been extremely technical people with deep industry expertise. And we've basically gone to them and said, we will help you find the business co-founder. Like we believe in what you're building. Like one, for example, was an insurance founder where it was a data science expert. And we said, we will go and help you find that person. And we did, and it's worked out really well, but it was never like, this is going to be the sole co-founder forever, right? It was us going and helping to find that person. And I think in terms of the co-founder dating, I think lots of VCs are people connectors. And so even talking to people before you start a company or before you start even doing your co-founder dating, like I'm sure all of us on this call probably have folks that we're trying to match up in our networks right now. And I think leveraging that ecosystem and just start to meet people, because immediately the ball is going to get rolling and you're going to get introduced to more and more people as people are aware that you're looking for someone. So I think it's all about putting yourself out there. And yeah, as Vic said, it's not too dissimilar from actual dating, I guess.
Excellent. So several of the folks on the call are international, and we have a question that came in from Paulo in Mexico, and the question is, what advice do you have for entrepreneurs who are outside the U.S. with little to no experience in the VC world, at least here in the Valley and in the U.S.? Is there some kind of bridge, kind of service that helps connect entrepreneurs to VCs? Do you have any thoughts on what international entrepreneurs can do to tap into the domestic here, at least in the US VC community? Curious, Dan, maybe you have some thoughts or others on that?
Yeah, it's a great setup for a pitch on Reaction. And Reaction has its members in 47 different countries. So most of the entrepreneurs that we're backing are outside of the US or focused outside of the US. And I can't tell you how powerful the Stanford network is. Stanford is time and again #1 in innovation. And what makes it obviously is the mindset, the frameworks, the things you learn on campus. But beyond that, it's this incredible network that exists and just finding a way to organize that network. In fact, the name Reaction was inspired by a woman named Ryan Price at Stanford. And she's talking about the mission of Stanford to change lives. And clearly, all of us get involved, our lives are changed. Change organizations. We go back, that takes effect in the organizations, and then to change the world. But to be honest, to change the world, there's a bit of hopeful thinking there, and that Stanford's entirely based at Stanford. And if Matt goes to give a keynote speech somewhere, he's got to be back on Monday to do the lecture. You can't miss a beat. So what happens though is you have all these alumni all throughout the world that are immersed in the nations, and what it means is they can open the right doors for ventures that go across border in health and in environment and all of those things. He said if we could somehow organize that, we could create a ripple effect for change using the alumni. And we thought about ripples like relationships, they diminish and then disappear. And clearly you want something that gets stronger and louder and amplifies over time, like a change reaction. And Reaction to play on that changes the shape of the A, and Stanford read as an extension of Stanford's mission to be able to take what starts anywhere in the world and to make it exponential throughout the world.
Excellent, thank you. So linking into the Stanford community can be very helpful. Anybody else have thoughts on how some international folks can bridge into the VC community here?
There may not be thoughts. I'll just add one more thing, which is
Sure.
This is the problem that we saw. There's certainly a lot to do for alumni in the Bay Area. And as you go outside, now the program I was part of was 80% international, 90% outside of the Bay Area. And so we're all saying, what the heck are we going to do to stay connected with innovation, with Stanford, with each other, with other alumni, which was many reasons. The reason that we created Reaction was to solve that problem, to give us a way to stay connected in a very purposeful way and to build something.
I think it's great. And as somebody who's taught that program that you were in, it's amazing to see what you guys have built, and the talent of the people in that program is fantastic. All right, I'm gonna synthesize two questions that are similar. I'd love to hear your opinions, and I'm gonna take one of the questions here as a wrap up for the Q&A part, and then I'd like to close our session out. So a question came in about other sources of funding, and I'd love to get your thoughts on crowdfunding, angel investment, when you might do one of those over going the VC route. I know you all have vested interests, but I'm wondering if you have thoughts that you might share with folks. So maybe step out of your role and just thinking about what you know. When might you suggest other routes of funding besides the VC route? Not sure who might want to take that. Vic, Lior, haven't heard from you in just a bit. Curious.
Sure, I'm happy to start us off. Yeah, I mean, I think at the end of the day, it kind of, there's one way of looking at it that's, who do you take money from? And then there's another way of looking at it, like, what are you trying to accomplish? And so to the extent to which, potentially like a crowdfunding source, if that's your, best option, and then, you're trying to create some form of network effect business, and perhaps by having, a lot of little nodes initially involved in what you're trying to build is helpful, then that can be, an interesting resource. And then from an angel perspective, if you're kind of going only that route, if you're building an enterprise company and having like a bunch of different folks at various companies being able to kind of represent you as again, nodes within those companies, that also makes sense. From our perspective, I think VC funding makes sense when you're trying to figure out kind of that 0 to 1 product market fit, and you could use kind of some guidance and mentorship and kind of a variety of different pieces of advice and help as a means of kind of getting your company from that 0 to 1 stage. But all the above makes sense. I'd say the one caution on crowdfunding, which is changing, and I do believe in it as a means of kind of getting out there, is that there can be some like legal ramifications. So you might want to make sure that you're kind of talking with whoever your lawyer might be when you're starting your company. What's the best way to obtain that crowdfunding? But otherwise, it's kind of trying to match up the company trying to build with the folks that you want to represent you as as investors.
Great, thank you for that. Other thoughts?
I think
go ahead, please. So go for it.
Just one quick thought is what the source of capital you take money from defines kind of like what your business objectives are going to be. VCs, as Lior like noted before, like to make fund models work, you kind of need $1 billion plus exit. And you should really think about whether that's the kind of company you want to build, whether that's like the path you want to set yourself on, because you set yourself down a very specific path. And I would argue that there are a very small percentage of businesses that are created that need venture funding and that kind of backing and goal setting.
Excellent, thank you. Thank you. Well, I'm going to wrap things up with one last question, and this is where I'm going to shamelessly plug something that I do, because this question hits exactly what I do when I wrap this up. So I have the good fortune to host a podcast for Stanford's Business School. It's called Think Fast, Talk Smart, where I get to interview people across the Stanford campus about communication issues. And I always end with asking 3 questions of each of my guests. And one of those questions mirrors a question that one of you asked for me to ask the panel, which is, what are some key ingredients that go into a successful VC investment? So if each of you, Amy, Vic, Lior, and Dan, we can go in that order, what's one key ingredient that you think is essential for a successful VC investment in an MVP company, or any company actually? Amy, do you want to share one key ingredient you look for?
Yeah, people, and being able to hire quickly and accurately.
Okay, so it's all about the people. Have the right people and be able to get people on board. Thank you. Vic, how about you? What's one key ingredient, or one or two?
White hot market. People just want the product.
Okay, so the need and want for the product. Thank you. Lior, how about for you? What's one key ingredient?
Have the founders navigated the idea maze thoroughly? And so do they understand all the nooks and crannies, and do they understand the market sufficiently enough to approach it?
So understand the market and the need well. Thank you, Lior. Dan, how about you? What's a key ingredient or two?
We won't invest in anything that we can't influence. And so if we don't play a role in the success, if we don't understand it enough and have doors that we can open, or a role that we can play that's really going to change the trajectory, there's no reason that they should take our money. They should go find a better partner.
Awesome, thank you. And thanks to all of you on the panel, Amy, Vic, Lior, and Dan. Thank you for your time. Thank you for your insight. Lots of key takeaways that can help anybody, either if you're currently looking for funding or thinking of forming a venture. Lots of good things to take away. I applaud all of you for taking time to listen and learn to this. The LEAD program is fantastic.